Okay, so now we have your keynote, Vitalik Buterin, and he's one of the founders of Ethereum, and he's going to talk about the crypto economic way, Ethereum, and the implications of a public blockchain.
Hello, everyone. Great. So just to kind of get right into things, here we have been for the last, depending on which systems you care about, the last 3 years, the last 8 years, the last few years, almost decade, building decentralized systems. And we all see decentralization as being kind of key to this kind of revolution that we seem to be building. But decentralized networks in general started long before blockchain specifically, right? So, and decentralized networks existed long before a big blockchain specifically. Then people trying to do peer-to-peer digital cash existed long before blockchains and Bitcoin specifically. So there's actually this kind of fairly long history of people all trying to do kind of similar things, right? Like the goal of the original cypherpunk movement basically is, can we use cryptography in order to reduce the need for central authority? Like this basically is what people have been thinking about in the 2000s, in the 1990s, to some extent in the 1980s. Right, so we have projects like Xiaomi and eCash, which is this very early thing that existed since 1982, which is a centralized kind of digital currency, but where users have privacy, and where users' privacy is protected even from the central bank. I mean, we have BitTorrent, decentralized networks for sharing files. I mean, we even have the equivalent of enterprise BitTorrent with, torrent networks being used by games like World of Warcraft to distribute updates to their millions of users. We see lots of projects like B-Money, reusable proofs of work, and so forth, all trying to do peer-to-peer cash in the 1990s and the 2000s. And finally, we got to Bitcoin in 2009. Now, to a lot of people, Bitcoin is this kind of ideological sea change, this kind of big fundamental revolution and of break in terms of the way that we think about building decentralized systems, the way that we think about money, the way that we kind of think about even like social and political systems to some extent. And I wanted to kind of talk about, what is it that was so interesting about this sort of sudden break in 2009. Now, this is a controversial subject, and a lot of people do have their own various opinions on this, right? So some people talk about the importance of, doing cash on a decentralized network, and some people specifically talk about proof of work, but my answer to this question is actually kind of very different from the answers that a lot of other people give. And in my own opinion, my answer is better than those other answers because that's a definition of it being my opinion. So my answer is that the specific interesting thing that kind of made things so fundamentally different from 2009 is what I call this concept of cryptoeconomics. Now, the way I define cryptoeconomics is it's the science of using cryptography together with economic incentives in order to... Whoa, this mic works, this mic doesn't. By the way, can people hear me? Okay. Oh. Okay. Hold on. How do I turn this mic on?
It's on the bottom, it's like a really tiny switch.
Wah. Okay, so what I see as being this kind of fundamental ingredient is what I call cryptoeconomics. And cryptoeconomics is the science of using cryptography together with economic incentives in order to achieve information security goals. Now, we all know about using cryptography to achieve information security goals. My files on my hard drive are encrypted, therefore, muhaha, you cannot get at my messages or my private keys or my crypto coins. This is using cryptography to achieve information security goals, where the information security goal in question is privacy. Let's say I want to send someone an email, and I want that person to know that the email really definitely came from me. And so how would I do that? Well, I could use something like PGP to digitally sign the email. So that's public key cryptography. That's using cryptography to achieve the information security goal of my recipient knowing that the thing that they got actually came from me and not from some other person. So here we're using not just cryptography, but also economic incentives. Now, what is the role of economic incentives? So cryptography is good at proving properties about messages that happened in the past, right? So like, you can use a digital signature to prove that a message that already exists came from some specific person, or at least some specific kind of cryptographic identity represented by 20 bytes of gobbledygook, but close enough. So cryptography can also prove that some piece of data, it points to some other piece of data. That's what hashes do. Now, what cryptography can't do is it can't ensure that certain properties of a system are going to continue to hold into the future. And that's what economic incentives do. So here is the kind of really interesting thing about what Bitcoin specifically did as a kind of founding innovation of crypto economics. Why does Bitcoin work? Because inside of Bitcoin, you have economic incentives, right? You have this incentive built into the system that if a miner creates a block, and this block is part of the main chain, so if a miner helps the system continue to maintain this kind of ever-growing consensus on transactions, then the miner gets 12.5 Bitcoins. If the miner does not mine, they get nothing. If the miner creates blocks and those blocks are not part of the main chain, they get nothing and they lose money because they have to waste on electricity. So what Bitcoin does, is it uses incentives that are defined inside of a system in order to protect and secure that system's ongoing existence. Now that's actually really philosophically interesting. It almost feels like a kind of snake eating its own head from the inside, right? You have a system with incentives defined inside of the system, and the incentives inside the system are what is ensuring that the system itself, including the thing that manages the incentives, continues to work. Right? So this weird kind of recursive, sort of economically self-supporting construction, that's the real interesting innovation. Now, so, what do we want, just as a quick example, what do we want out of a blockchain? Well, first of all, we want to have a chain of blocks. We want this system where there is this kind of ever-growing history, and where the system keeps track of the history and where everyone agrees on what the history is. We want to include transactions in each block. We want people to be able to send messages that represent stuff that they do, and we want stuff that people do to get recorded into the blockchain as, something that happened at that particular point in time. We also want to maintain some notion of a state. So for example, in Bitcoin, we want to maintain some notion of how much money does everyone have. Right? So this is the key piece that made peer-to-peer cash so much harder than all these other decentralized applications. When you're just sending messages, you don't really need people to keep track of all the messages that everyone sends. But when you're talking about cash, if I have 100 digital dollars, and I send 100 digital dollars to one person, and I send the same 100 digital dollars to the second person, both of those transactions can't succeed at the same time. Because if you can do that, then you can turn $100 into $200, and then the New Zealand dollar would hyperinflate faster than Zimbabwe. So, instead, so here, you really, in order for peer-to-peer cash to work, you have to have some notion of shared state, some notion of, well, how many coins do I have now? And how many coins do I have now? And do I still have the right to send that transaction? In Ethereum, the state is more complex. You have to keep track of accounts, you have to keep track of code, you have to keep track of what all the smart contracts are doing, and you want all your transactions to be valid, right? So you can think of these, on the kind of on the higher level as these are obviously properties that we want money to have. These are obviously properties that we want a smart contract system to have. But you can also think of them as on the lower level. You can think of them as these are kind of fairly mathematically definable properties of a system that we want to have. We know what we want. Now, how can we build a system that can ensure this? So the idea here is that basically we can use economic incentives. And we also know what kind of behavior by participants inside the system gets us closer to what we want, and what kind of behavior by participants inside the system takes us further from what we want. And we can use economic incentives to reward participants who get us closer and penalize participants who get us further. So that's the basic methodology. Now, Obviously, if you try and go into the much more deeply into the math, it gets very complicated, and specifically what are the best ways to do this often sometimes get tricky, but this is the same basic principle that applies pretty much everywhere. So basically, we have a bunch of tools. So, we have access to things like cryptography, we have access to signatures, we have access to hash algorithms, we have access to spooky advanced stuff like zero-knowledge proofs, and we have access to economic incentives, right? So economic incentives might come in the form of just giving people money. So if you define a system, then you get to define a cryptocurrency. And if you define a cryptocurrency, you get to define rules about when people get it and when you can delete people's money. And you can also incentivize people by giving them privileges. If you mine a block, you get to decide what transactions go in that block. And you can make money off of that. You can make money by charging people in order to include their transactions. So these are the kind of tools that we have to work with. And using these tools, it's actually possible to create this kind of surprisingly kind of rich set of applications, right? So the first app of crypto economics is the consensus layer, right? The first app of crypto economics is basically, can we use crypto economics in order to bootstrap the thing on top of which all the other stuff that we want to do is going to be built on, right? So what does this mean? Decentralized consensus. And second thing that this means is some kind of cryptocurrency. If you want to have incentives, in general, you have to have a cryptocurrency, and in order to maintain a cryptocurrency, you happen to also need consensus. So consensus is what everything sits on. There's obviously a bunch of ways to do consensus. You can talk about proof of work, you can talk about proof of stake, we can talk about kind of much more advanced ways to build blockchains, we can talk about sharding them, we can talk about scaling them, we can talk about building second layer protocols on top of them, but ultimately everything rests on consensus, right? So this is kind of the first layer. Now, as it turns out, there's also a bunch of fancy stuff that you can do on top of this. So one simple example is you can use crypto economic techniques in order to generate provably fair random numbers, right? So if I want to create a lottery, and one concern that people who might be playing in my lottery might have is, are the numbers actually random, or am I manipulating them? So that's actually hard to tell. You can't really look at a random number generator and actually tell for yourself whether or not it's random. With crypto economic techniques, as it turns out, we can basically put together a bunch of math and create a system which is guaranteed to create random numbers that are actually random and that are actually fair, unless people burn a really huge amount of money in order to manipulate it. This is something that can be done. Incentivizing file storage. I want somebody to store my file, and I want them to keep storing my file for 20 years, and I want them to be able to send the file back to me whenever I want it. You can use crypto economics to incentivize this sort of thing as well. Now, then on top of this, we've created a bunch of infrastructure, and on top of this infrastructure, you can suddenly do a whole bunch of interesting things, right? You can start thinking about applications across various kinds of industries where those applications heavily depend on this notion of state that everyone agrees on. You can think about applications where people can sign messages and these messages get published to the blockchain, and if a person tries to cheat, so if a person tries to, let's say one thing to one person and say another thing to someone else, then they can get caught. Right? You can create systems where if someone says something, then what they said will be available for everyone to see. Now, you can create systems that preserve transparency. You can even create systems that give some degree of transparency and some degree of privacy at the same time. I mean, you could even, you can create systems that keep track of digital assets. You can build things like provably fair decentralized exchanges that are resistant to front running. You can build lots of interesting things on top of this, right? So once you have this kind of base layer, and once the base layer works well, the possibilities for you can get built on top of it are actually pretty large. Now, so what's so interesting about all of this, right? So why does it make sense to build applications using on top of crypto economic platforms instead of just doing everything on top of a server? right? That's always what people ask, right? Why are you using a blockchain? Why aren't you just using a server? $10 a month. Come on, get the server. It's a really hard question to ask. I think we should just all go home now. So there are genuine advantages, right? So, and I generally split up these advantages into several categories. So we can talk about some of the more basic ones. So for example, if you build a blockchain application, you do, in many cases, can remove the need for yourself to maintain any kind of infrastructure. You don't need to maintain your own servers. Instead, basically, the platform and your users become the infrastructure. Instead of building an application where you serve things to people, you can build an application where people serve things to each other. Now, that infrastructure could be technical infrastructure, or it could be other kinds of infrastructure. If you want to build a new kind of insurance system, then if you're building in a decentralized way, you do not have to be the one contributing the capital as an insurer. You could build a kind of peer-to-peer system where people create kind of insurance pools where they provide insurance to each other. High security, so building an application on top of a blockchain is by far the cheapest way to build something that's guaranteed to not go offline every year and require you to spin it up again. High security, high reliability, difficult to attack, global. So, still cryptocurrency by itself is still by far the easiest way to send money from anywhere to anywhere around the world, from Kyrgyzstan to Guatemala in 30 seconds, just as quickly as you can send money to your own neighbor. And it's open. Anyone can participate, right? So, if we talk about permissionless innovation, if we talk about this kind of ideal that, people should be able to just get out there and spin up their own lemonade stand and sell lemonade just as, whenever they want to whomever they want to. And we want to do that for the digital world. Then, there's a lot in a lot of cases, there's a lot of barriers to entry that we would have to overcome. And practically speaking, these kind of blockchain-based crypto systems are one of the best ways that we have of really overcoming and reducing these barriers to entry. But now, finally, I want to talk about one particularly interesting benefit here. And this is what I call the social cost of bootstrapping. Now, as it turns out, there's actually two kinds of social cost of bootstrapping. One of them is the sorts of problems that you have if you're building a small application. One of them is the sorts of problems that you have if you're building a big application. So, let me explain. Let's suppose that you are trying to build a system, and this system could be some kind of financial system. It could be keeping track of some supply chain. It could be, a land title registry. It could be whatever. And let's say you want the system to be used all across the entire world, or even across a continent. Now, what are the problems that you have? If you're just trying to create a solution within a small group of people, then chances are there's somebody in that everyone in that group can trust. And you can just have that guy spin up the server, right? Now, let's say you go up to a country. Then you have a government, and the government can run it. And, the government can spin up a server. The government doesn't even need to get an account on Amazon. They can just run the server themselves. Now, what if you want to build an international application? Suddenly, there is no common point of trust, right? There is no corporation, there is no government that's literally trusted by everyone in the world, or even by everyone across an entire continent. So, how many people here trust the U.S. government? Oh, cool. Actually, no hands. How many people here trust the New Zealand government? More. But how many people here trust the government of, let's say, Kyrgyzstan? Now, you might guess that if you were in Kyrgyzstan, you might get a bunch of hands for Kyrgyzstan, but also no hands for New Zealand. So you kind of get the idea here, right? How many people here trust Google? Okay, see? Now, if this was inside of the Google offices, those hands might be a bit higher. So, the people that we trust are different. And the more you scale your applications up, the harder it is to find these kind of common points that everybody is willing to trust. So, if you're building something big, you have to go down to the lowest common denominator, right? You have to create an application where the story for why a person should trust that application does not depend on them trusting any specific individual or any specific institution. So, what is the lowest common denominator in crypto economics, right? What is the story for why I should trust that a crypto economic application is one that's going to continue running successfully? And the answer is simple. Number one, I know that cryptography works. And number two, I know that people like money. And because people like money and because there's economic incentives, I know that people are probably going to do the sorts of things that contribute to the system continuing to work and not doing the sorts of things that contribute to the system failing. So, who here trusts that people in New Zealand like money? Who here trusts that people in Kyrgyzstan like money? See, so you have a bit more social scalability. Who here thinks that SHA-256, the hash algorithm, works in New Zealand? Who here trusts that SHA-256, the hash algorithm, works in Kyrgyzstan? Who here trusts that people in North Korea like money? Social scalability. Who here trusts that SHA-256 works in North Korea? Social scalability. So this is one side of the social cost of bootstrapping. Here's the other side. Let's say that some random guy, Papa Joe, wants to open up, let's say Papa Joe's financial derivatives market. How many people here are inclined to immediately trust Papa Joe's financial derivatives market and start trading on it? How many people here are named Joe and have children? Okay, so it's a problem. If you're an entrepreneur and you're just looking to start a new thing, then a large part of the cost, a large part of the barriers to entry for you in order to go from zero to hero are costs of trust. In the 19th century, one of the main reasons why banks would build these really impressive buildings in places like the US is precisely because they wanted to look big and solid and trustworthy. I mean, these days we have supposedly more civilized things like suits and licenses, but there's still social technologies and they're still not perfect. So a lot of the barriers to entry, regardless of what system you use, regardless of how people are trying to solve the problem, really are costs of getting people to trust you. And if it doesn't look that way, it's because we have social systems that solve the problem, but chances are they introduce a whole bunch of barriers of their own. So here, what if you have Papa Joe, and Papa Joe instead issues a derivatives market as a smart contract on the blockchain, and then Papa Joe issues a formal proof where the formal proof mathematically verifies that these contracts have rules that say if you put money in, either the stuff that should happen happens or you get your money back. How many people would be more inclined to trust Papa Joe's financial derivatives market now? There we go, social scalability. So, these are some of the kind of trust benefits that we're talking about, right? So, what about permission consortiums? So this is often a surprisingly controversial, it's a very controversial topic in a lot of cases because in places like this one, there are people that believe permission chains are the devil, and in places that are in conferences inside of fancy large institutions where people wear suits and have licenses, you replace the word permission with permissionless, and that's the devil. So, what are the actual trade-offs between these two? So first of all, the trust model in these two settings is different, right? So in the permission setting, semi-trusted parties exist, right? Basically, the model that you're working in if you're trying to build a permission system is, you have some number of companies, and within this number of companies, you might not expect each and every one of them to be a nice guy, but you expect at least some of them, or at least a majority of them, to act honestly. Another one is you're not trying to build crypto-anarchic systems that can resist governments, right? So yes, it does mean that you can't resist governments, but it also means that it's easier for you to build things because you don't have to worry about resisting governments. So there are differences in the trust model, right? So yes, you can argue that permission chains are less decentralized, but at the same time, you can argue that they're more decentralized than nothing at all because the fact is 10 servers run by 10 companies are still far more secure than one server run by one company. But, yes, they are also less decentralized and trustless than 10,000 computers run by 10,000 random people all over the world. Now, interestingly enough, there are kind of surprisingly interesting similarities between this model and the fully permissionless one. And my claim is that the permission model relies on incentives too. Now, the incentive in the permission model is not if you're a nice guy, you get 25 coins, and if you're not a nice guy, you lose 25 coins. The incentive basically is if you act maliciously, then you will get caught, and you will get sued, or you will go to jail. So the system still relies crucially on incentives, right? People don't put their money into Goldman Sachs because they believe that Goldman Sachs are nice guys. They put their money into Goldman Sachs in part because they believe that if Goldman Sachs acts in a way that's malfeasant, they will get punished by regulators. So it's proof of stake where the thing at stake is your banking license. Now, this is a different security model. It's a legitimate security model, and it has benefits, though it has downsides. So for example, it relies heavily on social trust, and as I showed you 10 minutes ago, social trust is very hard to scale, especially if you go to applications that cut across the entire world. On the other hand, if you build these kinds of applications, you get to go down from 10,000 computers to having 10 computers, and your systems can be much more performance, process many more transactions, and maybe if you're running high-speed derivatives exchanges, it might be an okay trade-off. So the interesting thing, though, is in the similarities, right? In order to punish, you have to hold someone accountable. In order to be able to, all of these systems rely on incentives, and incentives often are punishments. And in order for punishments to work, you have to know who you're going to punish, right? You have to have systems where if someone does something wrong, then there's a proof of it. And half the fun of, half the challenge of building crypto-economic applications is actually figuring out the fault assignment. It's figuring out how do you build a system where if there is any deviation from kind of optimal behavior, if there is any deviation from the system working exactly the way it's supposed to work, then how can you build a system where in that case you know exactly because of whom the system did not work? Right? So that's actually half the challenge. And if you know whose fault something is, then you can punish them. And it doesn't matter if you're using social mechanisms, it doesn't matter if you're using legal mechanisms, it doesn't matter if you're just deleting their cryptocurrency balances. If you know whose fault something is, you can punish them. And so in many cases, there are actually kind of quite a lot of similarities between the two models. And I would argue that, even if public chains are the base layer, which really, does make a lot of sense if you're trying to build applications that go for kind of the kind of really the extremes of the two goals of social scalability. If you're trying to build something where it's either so small that nobody's going to trust your consortium, or it's so big that you can't make a consortium that everybody trusts, then you're going to have to use a public chain as the base layer. But there are going to be applications if you look at, for example, something in the supply chain. Let's say I receive a bottle of wine, and the supply chain records all say that this bottle of wine contains ethanol, and I drink the wine, and it turns out that the wine contains methanol. Then, it's cryptography by itself cannot prove what went wrong, right? Hash algorithms have no idea what the difference is between ethanol and methanol. That's a fact about the real world. And so in a lot of these applications that stretch beyond the purely digital, in order to go into being able to do things in the real world where, like atoms and people and personalities and legal customs apply, then you have to have systems where it's not purely the cryptography and the economics that's doing 100% for the work. Instead, you have to try and separate your guarantees. Right? You have to try and figure out what properties are there that you want your system to have, how many of those guarantees can be secured by the cryptography alone, what role does the cryptography have, can you try to get the math, get the economics, to try and take on as much of the responsibility as possible so that you have these kind of small compartmentalized kind of clear places where, this is where the social part applies. So in the supply chain example, you're not going to be using hashes and bits and Merkle trees in order to prove who is it that caused the wine to contain methanol instead of ethanol. Instead, you're going to be using all these hashes to prove person A created this object. Person A sent this object to person B. Person B signed off on receiving this object. Person B sent this object to person C. Person C signed off on this object, and so forth. And so you have a chain of people making attestations, and then you can start to prove where is it that things started to go wrong. You can show what is it that people said, and you can then start to get a kind of clearer picture of, if a fault happens, where is it that the fault originated. So for a lot of these applications, hybrid solutions are going to be necessary. Though for a lot of other applications, and they do exist, you actually can build systems that are kind of cryptoeconomically pure. If you look at storing a file, whether or not I have a file is mathematically and cryptographically provable, right? Whether or not I contain some file that has some particular hash is something that I can just personally prove to you, and this proving is done entirely within the world of bits. If we want to build let's say a decentralized version of basic internet infrastructure, this is probably something that people want because, we've seen that, with the kind of monopolized internet as it exists today, we have all these net neutrality issues and, ISPs have a huge amount of power. What if we want to make a decentralized one? Well, yes, you can purely cryptographically authenticate lots of things about whether or not internet connections actually are working as they should be. And so you can use cryptoeconomics to prove a lot of things. So, these are the building blocks. Use them, go out, venture, build, and hopefully next year, and 5 years down the line, we'll all see something very interesting. Thank you.
Check.
Thanks very much. Amazing talk. Really curious, because when you talk about this idea of social technologies and this sort of everybody buying into, or the social scalability, which I think is a completely fascinating idea. In many ways, nation states do exactly the same thing. Everybody kind of makes a social contract. And yet at the same time, we also have democracies because there are going to be, we all have to buy in and then work out what the rules are that we're all going to agree on. Curious how you think about governance from this perspective, and who makes the rules and then how do you get people to buy in on that?
So I would say first of all, the thing we have to realize is that in the 21st century, the mapping between a particular nation and society or even community is becoming more and more fuzzy and less perfect every day, right? How many people here spend more time just talking online to people outside their country than talking in person to people within their country? So, and as time goes on, this will only increase more and more, right? So, in the 21st century, we cannot rely so heavily on systems where we assume that people are kind of organized into these neat groups where the government is at the center of a group and organizes everything, because interaction is going to happen between groups, and interaction between groups is going to overwhelm interaction within groups, no matter which specific way a group organizes itself. We are not just people of one tribe, we're people of probably 5 or 10 different overlapping tribes. One of those tribes might be the country you're in, one of them might be the language you speak, one of them might be whether or not you prefer Bitcoin Core, Ethereum, or Bitcoin Unlimited, and one of them might be whether you like Vim or Emacs. So one of them might be just like what kinds of online media you consume, and so we have all these different ways in which we group themselves, and they don't really nicely overlap hierarchically. They don't really nicely mend themselves to the idea that there are a group of central authorities that manage kind of specific groups that are kind of neatly cohesive internally but isolated externally. And so, in order to kind of make the 21st century work well, new paradigms are going to be necessary, right? And I think, in the new paradigms that are going to be necessary are going to have to be decentralized ones. How many people here think it's realistic that everyone over the next few decades is going to agree on a global government that'll manage both the physical world and the internet, and we will all be happy about it? Wow, 0 hands up and even laughs. That's even fewer people than trust the US government. So, I think we need to stop thinking about governance as a centralized thing that comes down on high, and think about governance as a set of coordination institutions that people can use to work together in order to better achieve their common and shared objectives. And that's a style of thinking that it really does mend itself to thinking in this sort of more decentralized way. But it is also one that feels very different from the way the way that you might have thought about governance previously, right? And this is definitely an area that is, in some ways new, though in some ways not new. We've had overlapping tribes for millennia. We've had religions. We've had political movements. We've had nonprofit organizations. But this is in some ways it's similar to what we've had before. But in some ways, with the advent of strong information technology, and with the advent of all these different tools, cryptography, cryptoeconomics, the internet, to really help bring people together, we also have unprecedented opportunities. So I would just say that that's just it would be, we really do need to kind of think about these things in this kind of different frame, and I'm optimistic that humanity will be able to find its way through it.
Hey Vitalik, thanks for coming to Auckland. So we've heard that blockchain is incredibly secure and that it's also a bit slow in some cases with replication across the network. Can you talk a little bit about what you think quantum computing will do to those things? Sure.
So quantum computers are, it's a double-edged sword, right? And so quantum computing is going to do a lot of good things, for example, in AI, because it can probably, if it works well, then it can make a lot of algorithms much faster. In cryptography, I think in general, unfortunately, it does more harm than good. Basically, the reason being that you can use quantum computers to break cryptography much more easily than you can use quantum computers to make new forms of cryptography. And so entire categories of algorithms, digital elliptic curve signatures, RSA signatures, are going to not work well. If the deployment of quantum cryptography is unequal, if only the NSA has a quantum computer and no one else does, then the other problem is proof of work is going to stop working, because the NSA will be able to mine 30 billion times faster per unit energy than the rest of us. So, there are risks, right? But on the other hand, quantum computers do not kind of spell the end of cryptography completely. There are entire classes of algorithms that cryptographers have been researching for the last 20 years that are quantum safe, that can survive quantum computing. Lamport signatures, elliptic curve isogenies, lots of very fancy jargon that you won't know about unless you're a cryptographer. But there are solutions that people have been thinking about, and I think in practice it'll just look like like a switchover of protocols and an upgrade. And I think if we kind of figure things out, that'll be fairly smooth.
Hi, Vitalik?
Yes.
Yeah, thanks again for coming by here as well. So I had a question. I think no one raised their hand when you asked, do you trust Google? But if you asked, okay, how many people use Gmail, I think probably at least 80% of us put our hands up. So there's a model right now with Facebook and Google that we all know about, which is, the software provider gives you a free app, but then in exchange, they get to spy on you. And I'm wondering what your thoughts are, either your own or of others that you know in the space. Like, what's the alternative to that look like? Is there a version of Gmail that's more like a utility? It's a connection of different smart contracts. How does the pricing model work on that? And what do you think the alternatives look like that people will really potentially adopt in the next 3 to 5 years?
Yeah, that's definitely a complicated issue. So one of the natural alternatives to relying on basically information as a form of payment is relying on money as a form of payment. But then you have one of the things that I personally really like about the internet is just the sheer amounts of kind of financial accessibility that it brings. Is even homeless people now have access to more information through Wikipedia than the U.S. president did 70 years ago. It doesn't solve all of their problems, but it's still a pretty powerful equalizer. And I do worry that if we kind of decide ads are bad and we switched back to kind of a pay-to-play world for everything, then we're going to lose some of that. So, I do think that new paradigms are going to be necessary. I mean, first of all, I think that in general, ads are going to continue to exist, and the idea of monetizing information is going to continue to exist, but we definitely can think about how we can change the ways that we monetize information in order to still give people a value of the information, but at the same time increase user privacy and increase the extent to which people have control over how and when their information is being given and sold out. So, if you look at some of these decentralized identity systems that people are creating, we can imagine systems, and people are talking about this, build systems where people have all of their information by default, and if they want to sell some specific piece of the information to someone else, they can, but they have to opt into it, right? So at the very least, people know how much they're paying. And that's one example of an improvement. And other things that you could do, you could also imagine building systems that are kind of pay to play to some extent, but that give people opportunities to make money just as much as they give opportunities to spend money, right? So, that's also kind of an interesting direction that's probably worth thinking about. And it's, I think in general, I think this is still an area that's kind of fairly early, and I think we are going to see lots of different attempts at monetization being invented and tried and tested. I think the kind of important principle that we'd want to maximize is just the principle that, basically people know what kind of deals they're getting into. And, if we have that, then we can have much more confidence that those deals are going to be deals that we find agreeable.
Yeah, great talk.
Yeah, go ahead.
Thanks. You and I have talked about accountability before, so it's no surprise that I loved what you said about that. But I want to relate that to what you said about it not being a goal of permission blockchains to resist state actors. I don't really agree with that. I mean, even though we can't sort of resist absolute power, we can make it more accountable. So, for example, I might want to see proof that my random tax audit really was random, or that the regulators are regulating my competitors the same as they're regulating me, and so on.
No, that's okay. That's a fair criticism, and I accept it. Yeah, so I mean.
Oh, come on.
No, no, it's true. Like when I say resist state actors, I'm referring more to kind of Silk Road style, all out kind of no matter what they do, they can't stop us.
Right.
Forcing governments to act in a way that ensures accountability is definitely something that private and public blockchains can definitely both do. Yeah, go ahead.
Hey Vitalik. My question is in regards to ZK snarks. I had kind of mixed conversations around with Ethereum consultants around. So it's like here it's gonna be implemented after Casper implementation.
No, in Ethereum the ZK snarks are gonna come before the Casper implementation.
Okay, and another is there any plans to connect Zcash chain and Ethereum or or something?
So we've been collaborating with the Zcash team on getting snarks into Ethereum, and one of the other projects that we have been thinking about definitely is trying to see, are there ways to do a cross-chain exchange between Zcash and Ethereum? Are there ways to do things like relays from one chain to the other? Can you, build cross-chain lightning networks between the two and so forth? I think it's definitely possible. I mean, it's just the sort of thing that is going to happen once there's a team for it.
And there is no yet plans?
And so far, practically speaking, both the Zcash team and the portion of the Ethereum team that's focusing on ZK snarks are still fairly small, but I'm sure that if there is demand for it, it could be done.
And how it will be managed in a scale ways, because Z transactions consume more memory than the normal one?
Yeah, yes, they consume memory, and in Ethereum, the equivalent of consume a fairly large amount of gas.
So the sharding will work with that, or it will be
Well, sharding can definitely work with ZK snarks.
Okay, thank you.
Thank you. No.
Hi, so I had a sort of moral and ethics question for you.
Sure.
So with the development of smart contracts, it's now possible to create really, really evil smart contracts that can incentivize bad things to happen in the world, and there's no easy way of shutting them down or stopping them. So, how do we address people creating evil smart contracts?
Sure. So, I've looked at a bunch of the kind of things that you can do, and I think the answer is that in practice, most of the really evil stuff doesn't just depend on smart contracts. It also depends on smart contracts plus a link to the real world, right? So for example, if you want to build an assassination market where, if somebody wants to pay $100,000 to kill me, then okay, he can make a smart contract, but then there's going to have to be some kind of oracle that feeds in the data of whether or not I'm actually dead. And so let's say I find out that there's a $100,000 bounty for me. Here's what I'm going to do. I'm going to go and walk in the nearest police station, and I'm going to tell them, look, here's a contract for $100,000. If you help me play dead, then I'll let you pretend that you killed me, and we'll split the profits 50-50. So in general, right, like the kind of link between the kind of contracts and the real world is still this kind of very challenging problem, and it is fundamentally always going to depend on various like trusted or semi-trusted sources. And so that's the sort of thing that's probably the easiest to attack, right? Like that's the one link that's realistically going to be the weak link, both in kind of black contracts, black market style contracts, and even just like regular stuff that insurance that between regular people, right? So that's probably the one place where I can see a lot of countermeasures against this sort of thing happening. Like I can definitely see like data providers being willing to actively collude in order to steal money from these evil contracts, but by just like pretending that stuff happened that didn't happen, and then eventually soon enough they run out of money, and then the application stops existing. Like that's one of the better answers that I'd say I have at this point. I'd say I have at this point. Yeah. Sure. Last question. So you got to make sure that it's a good one.
I'll try. You talked about the social cost of bootstrapping. I'm just sort of a bit stuck because why hasn't a blockchain taken on Uber or like the banks? It feels like people aren't rational. We don't always behave economically. We often don't, probably. And I'm just wondering how that fits in and whether actually we just go for the shiny thing or the thing we know instead of the thing which is in our best interest.
That's actually a pretty good question. So I think there's a few things that are still kind of slowing down the growth of these kinds of applications. One of them is that the technology just isn't ready yet. Like the fact is that even if something really took off, Bitcoin and Ethereum, Bitcoin can only process about 4 transactions a second, Ethereum can go up to 15. Uber does I believe last time I checked it was about 100. And PayPal and financial systems and so forth do thousands. So that's one of the challenges. I mean, there's also a challenge, from a technological standpoint, things like user experience. Another thing that's an issue is the lack of a price-stable cryptocurrency. So this is something that I feel is just very important to the user experience of entire classes of smart contract applications, whether it's Uber, whether it's escrow or a whole bunch of things. A third one is just general in and out accessibility of cryptocurrency. A fourth probably is that doing something like that is, technologically speaking, it's still a fairly significant undertaking. And that's something that has to be funded. That's something that people have to figure out the business model for. A fifth problem is just network effects. So if you're going to build a new system in something like Uber, then you're not going to be able to compete with Uber directly, right? Immediately, right? You have to figure out some strategy for how you're going to get your first set of users. And even if your thing is better, that's often not very, very, very hard to do. If you're going to go in through the front door, then your thing has to be way better. And if it isn't, then you have to come up with some kind of backdoor that you can get in through. And this is just a business development challenge. So I think all these problems together are going to all have to be resolved in some way in order for that sort of thing to be successful.